Hello, James Blacklaw's JB Commercial Finance here. Now, when lenders look to lend money to clients, to business customers, one of the key things they look at is the sector the business is in. So, are they a manufacturer? Are they a service provider? Are they in the professional sector? Whatever it may be. And each lender will have their own traffic light system, red, amber, green, depending on where that sector fits within their credit policy. So for an example, a certain bank might have a great history over the years and a real appetite to lend to, let's say, doctors. So doctors would be a green sector which may benefit from preferential pricing with regard to the interest rates and the fees. They may benefit from preferential terms. They may be able to lend over a longer period of time, or they may just look more favourably towards that particular sector when it comes to lending money. Other sectors, such as, let's just say, restaurants, may have a more negative credit policy place in that sort of ladder, if you like. So because of losses over the years, because of the way that they're seen as a luxury, people, the first thing that's going to go in a recession is that 100 quid you might spend for your family to go out for a meal. So they're seen as a red sector, i.e. they're more volatile, more vulnerable, and therefore they're seen as higher risk, which means that lenders are less keen to lend to them. And if they do lend to them, then the criteria is stricter, the pricing may be higher, the fees may be higher, or they may lend less against, for instance, property purchase. So this has led to alternative lenders coming in to help fill that gap. And I've had an example of that recently where a public house was referred to me, a long-standing pub, who had real trouble with regard to their cash flow because they were losing money, and also they were in arrears with their HMRC commitments. In this particular occasion, it was their VAT. So we all know that people should put money aside for the VAT, but unfortunately some businesses simply struggle to do this on a month-by-month basis. Now fundamentally, this particular business had to do some restructuring, and when we worked on that, we've got some things in place. We introduced other people, and they made some changes that have cut their costs, and this turnover seems to be going the right way. So they're now at a stage where they're breaking even and they're moving the right way. But something we had to do was clear this VAT liability of around about £30,000, just a shade under. And the way we were able to do that was to look at their biggest source of revenue, which was card payments. So this particular business turns over approximately £50,000 a month, and around about 2/3 of that came via the card payments. So if someone goes in, spend 100 quid, instead of handing over cash, hand over the card, job done. Now those payments are paid every day by this card payment on a 3-day delay. So they'll come in, hand the card over, they have a couple of £1,000 there, it's paid a couple of days later, less the charges. And this particular business has shown a range of consistency with regard to their card payments at the sort of level of £45,000–50,000 per month. So we were able to utilise this to raise some finance for them. So this particular amount was no concern at all, so £30,000 over a year term to allow them to pay this VAT bill and get a little bit on top of things. And the payments for this loan are coming out of directly out of their merchant service receipts. So if they took £1,000 in a particular day, then a percentage of that was agreed, which in this case can be anywhere between sort of 5 and 15%, depending on how quickly they want to pay the loan back, straight out of the merchant service account, with the remainder paid to the business. Now this has a couple of positive things about it. First of all, the customer is not having to make a physical loan repayment. It adds certainty to the lender, who can see with relative assurity that the payments are going to be made because of the consistency we've seen over the period of time of taking these card payments. And it also means that they're a lot more flexible with regard to lending, with regard to things like credit history, with regard to the profitability of the business, because they can see the turnovers going through. So it works very well from a lending point of view. And for a client who maybe doesn't have the property assets, maybe doesn't have the business assets, maybe doesn't have the personal assets to support a traditional loan, certainly don't have the figures to support it, this is a way of utilising something to enable to have that cash injection to keep the business going. Now, when we're coming to talk to someone like myself, you're more likely to be aware of this kind of range of options. If you go to a traditional lender, it can be a struggle. If they can't offer you a loan overdraft or a credit card, then they can struggle sometimes to put alternative facilities in place for you, which can lead to some businesses struggling and then failing. If you come to someone like myself, we've got a range of options in our toolkit which we can utilise to help businesses, even if They're in that red sector and they can't borrow money traditionally from the bank. So come and talk to myself, James Blacklaws, www.jbcommercialfinance.co.uk, or comment in whatever social media format you're looking at here. Be delighted to get in touch if you know any pubs who are struggling and need some cash, or anyone else for that matter. Thank you very much for your time.